to tell us. What about the IT space, Reema? Take us through the bull and the bear case arguments. Go ahead.
Well, so the IT index has been one of the worst performing indices this week. The index was down more than 3%, and they've taken the brunt of the global bank exposure and the turmoil that we've seen over there. So here I'm going to present the bull versus bear argument, stack up a few data points for you to decide. So first, on the bearish point, Street is worried about the direct exposure of IT companies to some of the impacted banks, whether it's Credit Suisse or SVB. But even the indirect impact, banks globally in US or in EU may turn cautious. They could look to cut back on their spending. There could be a delay in decision making, and all this is likely to hurt the growth rates of Indian IT companies, and the outlook is very uncertain. So JP Morgan says the current estimates do not factor in the increased EPS risk from a further slowdown in spending. Kotak says the current growth forecast is for an 8% growth, but that could be impacted by 1 to 2% given what we are seeing globally. CLSA says there are two scenarios. One, if the crisis is short-lived and contained. In that event, we're looking at an EPS impact of 2 to 3% for some of the large companies. But if the crisis is prolonged, it's larger in scale, then the EPS impact could be as much as 7 to 8%. And Ambit says there is a risk that the overall impact on BFSI could be longer term. At that time, it's not just FY24 EPS, but even FY25 EPS, which could be at risk. So basically, on the bearish side, there is a lot of uncertainty right now, whether the hit on the growth is going to be 1 quarter, 2 quarter, or it's going to be more prolonged and hurt, the growth rates for the next 1 or 2 quarters. Remember, BFSI is the largest contributor to the Indian IT companies. Now let's present what the bull case is. One, with the correction that we've seen in the IT names, valuations are actually closer to their 5-year average valuation. Look at the TCS number. Current valuations are 24 times, but the 5-year average valuation is just 25 times. For Infosys then, current valuations at 21 times, sharp drop-off from the peak levels of 28 times and closer to the 5-year average of 20 times. And it's a similar picture for Wipro as well as HCL Tech. For Wipro, the current valuations at 16 times, closer to the 5-year average of 15x. And for HCL Tech as well, current valuations at 18x, closer to the 5-year average. So that's point number one. Valuations are closer to their 5-year average valuation multiple. The second bullish argument is that margins have already bottomed out. They're on their way to recovery, and the recovery is only going to gather steam. The reason for that is attrition is coming down sharply. Wage hikes in FY24 are going to be far more moderate given the layoffs that we are seeing, and companies are looking to improve their utilization. Utilization has some headroom, and subcontracting costs are likely to come down. And the third argument is that Indian IT has corrected far more than the Nifty, the benchmark index. From the peak level, the Nifty IT index is down 24%, while the Nifty is down 10%, and the Nifty IT index is actually closer to its 52-week low, just about 7% away. Nilesh, where do you stand on the bull versus bear argument on Indian IT, and between the large caps and the mid caps? Which one would you favor?
Well, Reema, it's a bear case for large caps and a bull case for mid caps in IT. That's the way I would put it. The large cap, unfortunately, I think they'll find it difficult to grow in double digits. At best, their growth will be in single digits. Even in a year like financial year 21-22, which was the best year for IT, a company like Infosys, probably the net earnings grew at just about 15-16%. So imagine your best-in-class company in your best year growing at just 15-16%. So we can imagine that when things normalize or in not so great years, the growth rates are going to be significantly lower. So it's pretty much like the FMCG space, where the large companies will find it very difficult to grow in double digits. And therefore, it makes sense to probably kind of take a look below the top 4 or 5 names and see where there's kind of incremental growth happening, where there's going to be a higher delta and therefore a higher alpha generation over the medium term. So I think at best, if there were to be a further correction, the large caps will give you nice trading bounces. But probably, I think the big upside is going to be in some of the mid caps, which are growing at a much faster pace.
Interesting point, Nilesh. Well, for the time being, Nilesh, request you to stay with us. We'll slip in a short break. We come back, though. We continue discussion with Nilesh, and we'll also take a look at the hotel sector on the other side.